Hi there, my name's Glenn Shanahan, and this is my finance presentation on the fast food and alcohol industries. So the first industry I'm going over is fast food. I was analyzing McDonald's, Wendy's, Sonic, Jack in the Box, and QSR, which is Burger King, Tim Hortons, and they actually just recently acquired Popeyes a couple years ago. So when first analyzing, it's good to look at liquidity and kind of make sure the companies are strong, stable, and gonna last a while. Um, when you look at their current ratios, they're all safely above one, and the only exception to this is Jack in the Box. But Jack in the Box has been doing some interesting restructuring with stock buybacks. So a lot of their ratios currently are a little out of whack. In a couple years, they had negative ROEs because they bought back more equity. So they actually had negative equity. And then you also see the same thing with the cash ratios. They all have a good bit of cash on hand, except for Jack in the Box. And big reason that is for Jack in the Box is because of the stock buybacks they've been doing. And then we kind of looked at their short-term solvency and saw the positions they're in, and then this is more long-term, looking at the total debt to total assets and the EBITDA to interest. The total debt to total assets, we can kind of see here that there's a lot of debt. Sonic and Jack in the Box have some of the most debt, and Jack in the Box especially, you can kind of see how their debts kind of increase with their stock buybacks. And that kind of goes back to kind of the strategy when you see that debt is cheaper than equity. So they're actually buying back their equity with debt because that's a cheaper capital structure for them. And so you see these companies, you just see that they have a lot of debt, and that's why we look at the EBITDA to interest expense, because we have to kind of look at, can they actually afford all that debt? And you can kind of look here and see that everyone can definitely safely afford their debt. Um, it's kind of interesting if you look at the graph of the whole industry. You can kind of see everyone, they're on a downward slope on being able to afford their debt, but they're still pretty safely in the clear. And QSR, you have like their Popeyes acquisition, and they actually kind of formed around this earlier time with the three companies in total. So they actually started out with a bad EBITDA to interest expense, but that was kind of because that's when the purchasing happened, and they've just grown it back into a safe area. Next, we'll kind of look at the profitability with some of the ROE decomposition. When we go through ROE decomposition, we see that when evaluating management, they don't really have control over financial leverage or the interest burden or the tax rates. But what they do have control over is the EBIT margin and the asset turnover of their company. So when evaluating how they're being managed, these are two that I definitely like to look at. Um, you can kind of see the margins. McDonald's and QSR are by far beating everyone else in the industry. Um, but the industry as a whole has been growing their margins. So you're definitely seeing an industry that's becoming more competitive and is becoming better at increasing their margins. Um, the only company, no, QSR also had a downward with the EBIT margin, but you can kind of see that everyone's on an upward trend, especially compared to 2013, except for again QSR is the little outlier. And when it comes to asset turnover, the industry as a whole is kind of flat. Wendy's is interesting with a slight downward slope compared to everyone else, but mainly the companies seem to have their rate that they turn over their assets and they kind of keep to it. QSR and Wendy's definitely seem lower than everyone else in what might not be a good way. So if you wanted to look at it from a positive perspective, you could say they have room to improve to catch up to the competition. The negative light is that they just aren't doing as well as their competition. So we kind of looked at their profitability, their company structure with debt, and just the way they structure their assets, liabilities, and equity. And now we're just going to look at how the market thinks of them. The first ratio we're looking at is the PE ratio. Um, this is kind of where you can get an idea about what the market thinks of them. The higher the PE ratio, the higher the market favors the company. And this is also where you get a high PE ratio could also mean the company is overvalued, but a low PE ratio most likely means that there isn't a good prospective growth in the industry. Um, in general, the PE ratios are kind of high. Sonic is the lowest at 18, but the industry as a whole has been growing their PE ratios. Sonic has they've kind of had the biggest decline compared to everyone else in their industry when it comes to PE. And next, we look at the enterprise value and the enterprise value added spread. The enterprise value is the theoretical takeover price, and we can kind of see most companies have been increasing their enterprise values. The only one that had a decrease was actually Sonic. Um, and it's interesting when looking at these numbers just how much bigger McDonald's is compared to everyone else. That's why I didn't put this on a graph because it would just look so skewed with McDonald's size compared to everyone else. Because from 2013 to 2017, their increase in enterprise value is more than the value of almost every company on here, except it looks like Wendy's. Yeah, Wendy's is the only company that enterprise value is bigger than the increase from 2013 to 2017 for just the value of McDonald's. So to really compare them and how they're doing with their assets, um, you kind of have to look at the enterprise value added spread. and this is how they're beating investors' kind of expectations, what investors put into the company, and what they did for their investors' expectations and their investments. Um, so you see, this is kind of where McDonald's sets themselves apart. And I think the most interesting thing when looking at the fast food industry as a whole is the two companies that kind of look the best from profitability and value wise. Yeah, Jack in the Box with the asset turnover, and McDonald's with their or EBIT margins. Um, is just Jack in the Box and McDonald's are definitely investing a lot of money into their companies. And really, so is QSR with their acquisitions. So you have QSR with spending all the money in the acquisitions. McDonald's, they're spending billions of dollars renovating all their restaurants, and they're also investing in um, new terminals in the restaurants that take orders for companies, for customers. And you also have Jack in the Box investing billions of dollars in stock buybacks to change their capital structure. Um, so when it comes to looking at these companies and their moves, the moves I kind of like the best is McDonald's because they're investing in their company, and you can see how with the enterprise value how they're growing the value of their company by directly investing into it. Jack in the Box is also growing the value of their company, but McDonald's is investing for the future, where Jack in the Box is doing a quick stock buyback to that's going to have good it's going to make their balance sheets look better, but it's not actually investing in their physical products. The next industry we're going to look at is the alcohol industry. Um, Compare the fast food, their ratios are definitely a lot lower. Um, and we look at their cash ratios. We have Sam here. They're going to be an interesting company to look at in this industry because just the way their company is structured is a different style than everyone else in their industry. And actually, it's just a different style than most companies I've analyzed. When it comes to the cash ratios, Tap US and Brew US, they're definitely kind of low, which means if something bad happened, they might not have the liquidity to deal with it right away. And we'll look at their total debt. Similar to the fast food industry, they're a little bit high. Not quite as high as fast food. But we have Sam here who doesn't deal with debt, and Brew US is also pretty low. And then we look at how they can afford it. We actually have Sam's the outlier because they just don't deal with the debt. They don't have any, so there's no interest expense for them. Um, and the interesting thing is, compare the fast food industry, this industry seems a little less able to cover their debt. They can still cover it fine, but compare the under industry, it wasn't that much. But then you have Brew US and Sam just as the outliers, with one definitely way over can afford the debt, and Sam just doesn't have any. And when we start looking at their profitability and how they compare to each other, their margins are pretty strong, except for Brew has really low margins compared to everyone else. Hopefully that means they have room to improve. Um, and STZ and ABI are definitely leading the pack when it comes to the EBIT margin. And when it comes to asset turnover, it's kind of an interesting thing. Sam and Brew weren't that high on margins, but when it comes to turnover, they're way up there compared to everyone else. It's Sam, Brew, Industry, and then everyone else is down here. So basically, with all the ratios we've been exploring now, we've had these three are seem to be run and structured similarly, while Brew and Sam have their own different management styles. And when it comes to the valuation, we can see that from the PE ratios that the alcohol industry is not quite as valued as the fast food industry. Um, but that can also mean there might be better buys in this industry. And then we can look at the enterprise value and how they've been growing their companies. Um, STZ has definitely been very impressive. They've grown almost 4 times their value in 5 years. Um, it's kind of sad to see that Sam has fallen in value, and Brew US has had kind of some up and downs. Um, it's interesting that Sam has fallen in value, but their spread has been the best in the industry. So they've kind of downsized. They haven't taken on debt, and but they've kept making good value for their investors. And but the EVA spread in the industry kind of shows in the PE ratios how the alcohol industry isn't more favored than the fast food industry because they are not getting the same amount of value from out of their investments. They aren't making the same type of returns. You only have two companies with a positive EVA spread, which makes you think that the alcohol industry might not be the best industry to invest in at the moment, especially when the one company we're looking at that has the best spread is the one that has actually been declining in enterprise value, which makes you think that when comparing the alcohol and fast food industries, the industry you'd more rather invest in would be the fast food industry, which kind of makes me just not want to invest in a company in the alcohol industry. And thank you for watching my presentation, and that kind of leads me to picking my favorite company out of the two industries. And that company was McDonald's. The industry seemed a lot stronger. Everyone was growing their values. McDonald's had the best EVA spread. McDonald's had good margins. And really, it was just kind of their management style that drove me to choose the company. How they've been investing in their restaurants and their physical locations, but not only that, that they've been investing in technology for the future compared to Jack in the Box making investment moves, but they were only investing in financials, just buying back stocks to make their balance sheet look better. Um, and yeah, thank you for watching. Bye.